I'm Philippa Malmgren, and I've been asked by M&G in recent years to give my views about what's happening in the world economy. I think in part because I specialize in looking at the risks of the portfolio that we cannot quantify: politics, policy, geopolitics, which are increasingly important. Well, the last 6 months has been full of event risk, that's for sure. But I think there's some themes within that are worth paying attention to. One is something I've talked about a lot in the past, which is food inflation combined with higher energy prices, which is squeezing the incomes of workers in emerging markets. And this is ending up in civil unrest. Now, we see it in places like North Africa and the Middle East in the form of people go into the streets and then they turn their energy towards their old grievances. So the demands for democracy become apparent. But the same set of pressures is at play throughout Asia. And I think people would be making a mistake to think that this is an Arab Street phenomena. This is about all emerging markets being hit by this price pressure and getting people into a mode where they're willing to engage in civil action one way or another. I'm worried now, given the incident in Japan, and we still have a nuclear incident there, and we don't know the full consequences yet of it because it's not under control. And the reality is that any contamination to the food chain in Japan has enormous consequences for the world, given that it's the third biggest economy in the world. For example, rice. I fully expect that they will have to start eating into the food stocks of rice in Japan. So I think we've got about 6 months, but after that, I would expect to see rice prices starting to go up. If rice goes up, then we're going to see Asia having the same sort of civil unrest, demands for change kind of issues and developments as we've seen in the Middle East and North Africa. In Portugal and Greece and other European countries that have this extraordinary debt burden, but even in the ones that aren't on the brink of default, in the United Kingdom, people are beginning to register the full nature of the loss that has been incurred during this financial crisis, that they won't be able to depend on the state to provide certain services or even maybe their pension as they had assumed the state would. And as they absorb what the state is telling them, i.e. we're not going to pay for stuff, you're on your own more and more, people are feeling the unfairness. And so they protest that the distribution of the wealth and the assets in society was uneven and benefited some more than others. In the US and across these other countries, what I hear is this is political suicide. For example, in the US, I think that the Obama administration have decided not to pursue very much fiscal consolidation. And if the Republicans want to pursue that agenda and commit political suicide, let them. In the United Kingdom, I think that the leadership here has been more aggressive, probably more realistic about the need for budget cuts, but maybe they have the latitude to do that because of the hung parliament. And so there's a greater consensus about what needs to be done. But even still, it's very painful here, and the public is resisting in the form of social protest, which we are seeing, which involves riot police. On the continent, it's just a plain punch-up about where the pain will fall and no agreement. And in Japan, just the beginning of the recognition that the debt problem cannot be financed in perpetuity. So globally, what do I see? I see a world in which traders, investors think, surely governments are going to tighten their budgets because they have no choice. And then what I hear from politicians in all these locations is exactly the same. We absolutely cannot afford to squeeze people too hard, because if we do, we'll be thrown out of office. For a lot of investors, they're Keynesians, and they say, if you tighten the budget, you kill growth. I take a different view. I say if you tighten the budgets, you give oxygen to the private sector. And we'll see a lot of activity move from governments into private sector businesses. And this is a good thing. But philosophically, I'm on the other side of the equation, right? I'm with Milton Friedman on this. And I think that most investors need to think, am I with Keynes or am I with Friedman? It's a philosophical issue that lies at the center of your portfolio decisions. I think maybe a central feature of the next few years is going to be understanding how to invest around the redistribution, reallocation of the assets and the wealth in these societies, and it's all based on making a fairer picture. And that's why I say I think that actually this is pretty good news, in fact. I mean, I know it's easy for investors to get nervous when you have civil unrest going on, or when you're on the edge of default, or when you don't know how Japan will ever rebuild itself given their debt problem. But I think the reality is that as these societies come to a new arrangement about who bears the pain, who has the greatest opportunity, how the wealth is distributed, this creates a foundation for growth. So I'm actually quite optimistic about how this will play out. I think we are going to have defaults. I think we're going to get announcements about governments being unable to meet their debt obligations, and there will be a restructuring. The good news is the markets are pretty ready for this now, fully discounted. I don't think you create any shock horror headlines if you end up with the Financial Times reporting Portugal extends the debt payments. And that's exactly how it'll be phrased. You know, they won't say they defaulted. They'll just say they extended the debt payments. So I think that these things are being resolved in a way that investors can take advantage, but it does require care and attention, and being risk on, risk off is not going to pay. I think inflation is definitely ripping through the international economy. And people keep looking for the data points to move. They watch for the American CPI or the CPI here in the UK, which in fact has ticked up a bit. But their general expectation is that inflation is going to be pretty low, and maybe even that it's temporary. I don't think that it's temporary. So let me give a couple of examples of what I see. I think there's a lot of embedded inflation. It's invisible. It's not showing up in the data point. Because if food and energy are the main prices that are rising, they're never going to show up in the core CPI in the United States, because we don't include food and energy in that calculation. But even more to the point, let me give you a visual. Isn't it interesting that Cadbury's has reduced the size of their chocolate bar by taking 2 squares off? And they move from, I think it's 160 grams to 140 grams. Why are they doing that? Because sugar prices have catapulted. So as this occurs, we got margin pressure. And smart companies like Cadbury's are going to start to try to control the margin pressure by physically giving you less, but making you pay the same price. I like strong brands where there's an ability to pass on higher prices, and I think those will become more valuable over time. I like companies that can generate genuine unimpaired cash flows, because that can outrun inflation, and that can withstand a world in which liquidity is withdrawn. Even though I don't expect liquidity to be withdrawn in the next 6 months, markets may start discounting it within the next 6 months. And therefore, you want to own things that will stay up in value even as liquidity is reduced. So overall, I'm actually feeling reasonably optimistic in spite of my inflation forecast. But being careful about what you own and the reasons why, and keeping in mind those cash flows are the central dynamic that matters, I think that will pay.